Hey guys, Dan Lucchese here with the Lucchese Property Group. It is July and here is our market update from the June data. A couple things. Active inventory, we are now at 1,760 units detached single family houses and 879 attached units. The close to original price ratio in June for detached was 105.8%, and in the attached market was 104%. Let's see, this is a big number. The average sold price, $723,429, and the attached, $436,000. The median sold price, so the median home that was sold in Metro Denver in June for detached was $600,000. So that's a big jump compared to what it's been even increasing over the last couple of years. So it really took a pretty big jump upward just the last few months. Median days on market, 4. So homes are selling quickly, and that's for both the attached and the detached. They are going under contract very fast. In fact, 82.8% of the detached homes went under contract in 7 days or less, and 75.8% of the attached went under contract in 7 days or less. And then the average interest rate, this is important, 2.98%. So the average buyer is getting an interest rate around 2.98% right now. And I wanted to show you guys a slide that we're going to put up here on the screen of how much of a break or a throttle the interest rate has on what home prices can do in the market. So as you can see here, when the interest rate is as low as 2%, the same buyer trying to maintain a $2,245 a month mortgage payment, assuming, and this I think assumes a 10% down payment, but that buyer at a 2% interest rate can afford $607,831. In contrast, as the interest rate creeps up, look how much their buying power decreases. By the time that same buyer with the $2,245 mortgage payment gets up to a 6% interest rate, we're looking at $374,484. So that's pretty dramatic. You can see how the Fed controlling interest rates really has like a brake and a throttle under their control. And because of COVID and the way things were before, they were really keeping the interest rates low, which is a big part of why the why the home prices continue to go up. So let's talk a little bit more about housing affordability, right? Because I know everyone feels that this is moving away from them, but here's some data that kind of talks about the reality of what's going on. So we'll put a slide here up on the screen, and what you can see on this slide is that since 2005, the interest rate is down. It was up around 5 to 5.5% at that time, and we're floating right around 3% right now. And as that interest rate has gone down, in the same period of time, the principal and interest payment, again, assuming that 10% down payment, has climbed from about, let's say, a $1,600 principal and interest payment up to about a $2,700 a month payment. And so they're $2,783 to be specific. And so what is driving that? Interest rates are down, but people are paying more principal and interest. It's the home price, right? So that is what's going on there. Now here's what's really interesting about affordability. Take a look at this slide, and what you'll see here is that as a percent of their income, people were paying, and this was in Metro Denver, people were paying about let's call it 31% back in 2005, and it hit a peak in 2006, that was maybe like, it had climbed to about 37 or 38% of their monthly income was going towards principal and interest payment on their housing. Right now, that number is right about 33%. So we are in a direction of approaching how much people were paying back in that 2006 timeframe, but we aren't there. And so that suggests that this is a factor that contributes to whether housing is affordable or not. People are on average spending about 33% of their income on housing. That is a lot more than the low point when the market was down around 2009, 10, 11, and even 12. But really that goes up. That was a very low number in the historical scheme of things. And then again, we talked about the payment. People are on average $27.83 is what their mortgage payment is. So that has increased pretty notably since 2005 and 6. So the other thing that people ask me about and want to talk a little bit about is the distressed market. Well, let me put up this slide. Here is the distressed market back in 2008 after the previous collapse, and here we are today. So there's really not a distressed market in terms of sales of houses. That is, what we do have is a very high percentage of delinquent mortgages. And because of the stimulus package that has been originally promulgated under the last president and perpetuated under our current president, the lenders aren't foreclosing on these delinquent mortgages. And at some point, that has to stop. And the people that can't get their mortgage caught up are going to be facing foreclosure, and we will see a spike in the number of sales that are coming from the distressed market. So those are things like government-owned or government sales where people are behind on taxes, bank-owned properties, and short sales, which are where the seller still owns the home, but they can't. What the house is worth is less than what the mortgage owed to the bank is, so they're gonna get permission from the bank to sell it for less than what they owe the bank. That's a short sale. So, guys, I hope this information is helpful. If you want to talk about the market and whether it is or isn't a good time to buy, I'd be happy to coach you guys on that. Give me a call. Our contact information is below. You can always reach out to us, and I'll look forward to connecting with you guys. Thank you so much.